Mathematically, a covered call and a cash-secured put at the same strike price have the exact same profit and loss graph. Many traders treat covered calls and cash-secured puts as completely different animals. One is viewed as income on assets you own, the other as a way to buy dips. However, under the surface, they are synthetically identical. Let's define them quickly. A covered call involves owning 100 shares of stock and selling a call option against them. You cap your upside in exchange for premium income. A cash-secured put involves holding enough cash to buy 100 shares and selling a put option. If the stock drops, you buy the shares. If it stays up, you keep the premium. Here is the magic of put-call parity. Long stock plus a short call equals a short put. In financial mathematics, these positions create the same risk profile, assuming the same strike and expiration. If you graph the payoff, both strategies lose money as the stock drops below the break-even, and both cap profit at the strike price plus premium received. The curve is indistinguishable. So if the math is identical, why do we choose one over the other? It comes down to logistics, efficiency, and where you are starting your journey. The first practical difference is your current holding. If you already own the stock, selling the call is efficient. Selling the stock to sell a put triggers taxable events and transaction costs. Next, consider dividends. With a covered call, you are the shareholder of record, so you receive the dividend payments directly into your account. With a cash-secured put, you do not get the dividend. However, the options market is efficient. Put premiums are usually inflated by the expected dividend amount, compensating you in advance. This leads to early assignment risk. In a covered call, if a dividend is imminent, you are at high risk of having your shares called away early so the buyer can capture that dividend. Buying power is another differentiator. In a cash account, both require full collateral. But in a margin account, a naked put might use less buying power than holding the full stock position. However, getting approved to sell puts, even cash secured, often requires a higher options trading level than simply selling covered calls against existing shares. Let's look at return on investment calculation. Because the capital requirement might differ in margin accounts, your ROI percentage can look drastically different even if the dollar profit is the same. Psychologically, these trades feel different. Selling a put feels like buying the dip, a bullish entry. Selling a covered call often feels like taking profits or exiting a position. We must also consider the assignment flow. This is where the wheel strategy connects them. You use the put to enter and the call to exit. In a bear market, managing these positions differs. Rolling a covered call down is a defensive move to reduce cost basis. Rolling a put down is chasing the stock lower. When rolling a cash-secured put that has gone deep in the money, you may struggle to get a credit without extending duration significantly. The liquidity on deep IDM puts can dry up. Conversely, rolling a covered call is often easier because you are usually rolling in out of the money or at the money option, where liquidity is highest. Tax treatment is your final logistical check. In the US, holding stock for over a year qualifies for long-term capital gains. Constantly spinning the wheel resets this holding period. So how do you decide? Use the put when you have cash and want to enter. Use the call when you have stock and want to generate income or exit. If you are indifferent and have a margin account, the short put is often slightly more capital efficient, leaving you with free buying power for other opportunities. Remember, while the math is the same, the path you take to get there changes your flexibility. Choose the tool that matches your current portfolio state. Master the synthetics, but respect the logistics of your broker.